Hey guys, Freaky Finance here. Today we're going to do a video on banks. I was going to jump right into a bank, but I think with this video we're just going to lay the context, and I'm going to use this for when we actually go into a bank specifically. For today's purposes, for the example of a bank, we're just going to use RBC. It's the biggest bank in Canada. One of the reasons why is they just had a pretty good conference on two key concepts I want to talk about. I do own Bank of Nova Scotia and BMO, and basically the reason for the video and why I want to do it at the beginning of this year, I'm kind of hoping banks get cheaper again. Now they did a little bit, and I did pick up some in October, but I am hoping that there's a credit provision panic, not necessarily a panic, but there's an opportunity to buy more banks at a cheaper price. So I want to get the video out, so if that happens, I can rewatch this and probably another couple bank videos that I might do at some point and be more confident to jump in. Okay, so let's get into it. So every bank is slightly different, but they're all relatively similar. So what I mean by that, they're always going to have a core bank business. So the core part is going to be the deposits that you're taking in, and then you're taking in deposits. Really the whole point of the bank is to make money on a spread. Really it's the spread game. So you take deposits in, and really you're re-lending it to other people. So the point is to lend. The bulk of a bank's purpose is really to take capital from certain people and give it to other people, and hopefully the capital is structured to create value that the person that otherwise never would have had that capital would have been able to do. So just think of it like you save your money, deposit in a bank, that bank lends it to someone like Edison who invented light bulbs, something like that. Really it's to lending to entrepreneurs, to businesses, stuff like that. And really the bank just makes money on the spread between that. That's the core function, and if you can get the rate of change on that, called the NIM, you probably do well over time with banks. Now, I guess the other thing to think about is credit provisions. So when you're lending, you need to make sure the person that you're lending to can actually pay you the money back with the interest, right? So what banks do is they also do credit provisions, and that is they try to provide ahead of time what they think the likely hits to their lending book will be, aka what they'll have to write off at some point. And usually the banks bottom right before they put up the worst rate of change in provisions. So, for example, Scotia had a pretty bad Q4 in terms of credit provisions, and so that would represent a time to buy historically. And now other banks might do the same later on. So that'll be a fun one to see, because that's generally the best buying opportunity. Because what happens is, sure, things get bad, they provide for it, and then after that, they basically ride a provision reversion cycle, which makes earnings look too good, and that's when you usually get this quick pickup after the fact. So I'm hoping to ride that provision panic cycle. It's usually the easiest one to ride in rate of change terms. So the trick is trying to get in at the time when the provisions are peaking, or slightly before we'd see it on reported numbers. So with that in mind, there's also other things. So wealth management's another one, and that'll generally be market beta. So it'll go up with the market and down with the market. Okay, when investments are doing good, the wealth management business will be doing good because they generally ride on that with their fees. And during times when trading activity is higher, some will have capital markets, so that's more of your underwriting and equity issuance. So just think of a company like Goldman Sachs that does quite a bit of that stuff, bringing companies to market, doing M&A, stuff like that a bank also gets a fee on. All right, and then you'll also have insurance, some banks. I think I did power once. Maybe I'll jump into insurance companies at some point. All right, so one of the reasons why I like the setup currently is that we've seen rates shoot up materially, and we've also seen a lot of money move from mutual funds to term deposits. Now, a term deposit, just think of them like a GIC for our purposes. Basically, what that is someone decided, you know what, I'm only making 5% of the market a year. I see GICs at 5%. I'm going to buy a GIC. What that does, so say your mutual fund was in a whole bunch of different securities, probably dividend yielding ones, it was a balanced fund. What that does is, instead of your income being driven by equity results from the company, you're now getting money directly from the bank. And again, what the bank is doing is trying to lend those deposits to other people and make money on the spread. So what this means is that we saw a huge upswing in deposit taking, a relatively elevated loan growth. The deposits were coming in at the elevated rates. So what I mean by that is that the deposit book was resetting at the higher interest rates quicker than a loan book could. And that led to normally a bank would see margin expansion during this time, and most of them did slightly. They didn't see that much margin expansion, especially for how quick the rates increased. So what we should expect, and this depends on the bank and how much mortgages are resetting in any given year for the loan book. Let's just say RBC has a 15% loans resetting this year. And again, the Canadian banks and American banks are going to be very different. A lot of the Canadian banks actually reset quicker. So they should see more pressure on the consumer quicker. That means that rise in interest rates would impact the Canadian economy quicker. You have to remember the boa constrictor is the bank for the economy. And that's going to show up in the NIM over time, I think, for the banks. That's why I'm excited about banks. That's why I wanted to do a video going into 2024. So anyway, the main concept here is that we've seen deposits reset at these higher rates quicker than the loan book side. And that's kind of what this looks like. So we've seen NIM go up from 2.68 to 2.71. That doesn't sound very exciting. It's only 3 bips. But the the thing is, this is on $880 billion of loans in RBC's case, right? So it's a material increase, is what I'm trying to say, over time. And this should accelerate in 2024 because the deposit side has stopped resetting, rates have flattened, and then the loan book is still catching up as, so just say, mortgages renew. So the 8K, even if rates stayed the same, even if they came down based on the forward curve, the bank is still going to be constrictive. So the economy is still going to be rate of change more and more tighter, even if the rates stay high, even if the rates go down 6 times in 2024 like the forward market's predicting, it's still going to get tight and it's still going to be ugly, which makes the timing of adding to the banks very hard, right? Because at the same time they have to provide for the credit side of this. They are the tightener, and they also need to make sure that the people they lend to can still pay them back, and that's usually when delinquencies rise the most. And that's usually when you get the best deals for banks, because the market tends to panic at these high credit provisions when they occur, or slightly before. So what I'm trying to show here is just when you look at a bank, all the Canadian banks have a good thing called supplementary information when they post their earnings. And I'd suggest looking through them. You can see assets built pretty quickly here. And again, the assets are the loan side. We'll go directly to the loans after. But you can see deposits as well here. And basically, what you're trying to see is the loan book expanding roughly at the same rate of the deposit book. And if its rate of change delta is accelerating or decelerating, and then try to explain why. One of the interesting things we saw is that lending actually has been slowing in Canada. Because of higher interest rates, people are less likely to buy expensive things that require financing because it's harder to actually buy them because interest rates are so high. So we've seen that kind of shut down, but the banks are very slow to cut headcount. They kept hiring even though lending was slowing, and now we're finally starting to see lending come in. On the next slide, this one's probably one of my favorite on the supplementary information, because this is just all the loans and acceptances. So you see L and A, that's kind of like their loan book. That's what I call it. So here, what you can see at the bottom, they have $880 billion lent out across all these different vehicles. A lot of it will be, depends on the company again, but a lot of it will be mortgages in Canada. But they also lend to a lot of businesses. You can kind of see that here. This is what I kind of look at. And the idea here is just the banks carry a thing called ACL, so the allowance for credit losses. And that's really on the book, how much have they provided against their current loan book. That's how I view it. And so you can see during the last year, the provisions to RBC's credit have gone from 3.8 to 5 billion, which has hurt earnings, because basically when you increase the provisions, you actually hit earnings at that time. You're not actually waiting for you to have the bad debt expense show up. You're actually basically expensing that debt before it actually happens, or expensing that expense before it actually happens, or view it as like writing down ahead of time. And generally, this should be increasing more. That's what I'd argue right now. So while provisions have increased, they haven't increased as much as a normal recession would indicate, which means, in RBC's case anyway, that the bank hasn't provisioned enough for the current environment. Or that's what I'd argue. That's why I don't own it yet, even though I have a favorable outlook on the NIM. Here on the other side is just the PCL. So that's actually what you'd see hitting the income statement, the P&L, every quarter. And so the higher this is, the lower the EPS will be. And so when you have that big provision in the dividend quarter, you're going to see the EPS go down. You're going to see headlines saying banks have record losses. And that's when you got to buy them, because they're providing for something that may or may not happen. And usually they're overly conservative at that very panic rated change off. So usually the small build up is normal, and then you get a real buying opportunity when they accelerate the provision. Or at least that's what I'm thinking. Here's just another way to see how the allowance for credit losses and provisions work. So you can see here's the allowance. So again, L and A is loans and acceptances. Here's the 880 billion. And you can see they've increased it from 50 bips to 61. So they have increased the provisions as a percent of their loan book. And you can see that here through the PCL. So again, the PCL increases the allowance, whereas the write-offs, when you actually write off the debt, it actually decreases the allowance. Here's the renewal risk. So in RBC's case, one of the things you got to look at in 2024 is what bank is going to reset the most and have provided enough to accommodate that. For example, RBC only has 14% of the loan book renewing in 2024. It's both a double-sided sword. So on one hand, you're not going to have that same kind of NIM expansion because only 14% of the book's resetting on the mortgage side. But at the same time, you might not have that same kind of credit risk. And so that's the trick. And you have to try to decide which bank is, say, under provisioning or over provisioning, or which one has the most opportunity once there's a panic and they finally catch up on the provisions or overestimate their provisions, right? That's kind of how I look at it. And then you can also see where they're resetting at. So 14% of their book is resetting this year. Their average fixed rate is 3.6. We know that most of them are going around 5.5 for a 3-year or 5-year fixed, something like that. So you're thinking you might see 2% more. And that might sound small, but someone paying that could be very big depending on the mortgage size. So I think that's worth bringing up. I always like looking at this slide because that tells me how the family's getting to get hit, right? So here you have 14% of their loan book. That doesn't mean 14% of Canadians. Because not all Canadians have homes, stuff like that. And other banks will have more resetting this year and stuff like that. So you can't look into the whole Canadian economy like this, but you can kind of see for this bank what's likely the impact going to be on the NIM side this year. And then you can also see here, what I like to see is the delinquencies, and they have been rising, which also correlates with what we saw with unemployment getting worse in Canada. So we are seeing more and more interest rate pressure. This is what I always one of the first things I looked at, because a lot of headlines always have Canadian banks are doomed. And when you look at their actual balance sheets and kind of how they're structured, their mortgages are very, I'd argue, they have a lot of equity cushion. So you need to see house prices on average collapse 51% for the bank to actually see any real pain right down. That isn't to say that people will walk away when their equity goes to zero if that were to happen, but they do have quite a bit of equity cushion. And this is indicative, I've followed enough of the banks now to know this is fairly common, 49% loan to value. And you can see even in places like Vancouver, 46 loan to value. The biggest risk ones will be the ones that have the highest loan to value, which will be the ones that are at origination. Basically, how banks work, not only are they front loaded to reward the bank for mortgages, the amortization schedules, but they also basically, as you pay down your mortgage, you actually give the bank more equity cushion from a risk standpoint. So you become less risky the longer you've had the mortgage, because your mortgage is slowly getting paid off. And your house value generally is going up over time. Not always, but generally, especially over a long enough time. Here is just the one last concept. It's not too important, but it is important when it really matters. So the set ratio, really, it's just a fancy way to say what their total, how are they capitalized, and divide that by their total assets. And the total assets for the bank, just think of that $880 billion that RBC has lent out. There's more than that on the asset side, but just think of that as the asset. It's basically their lending base, as well as a bunch of other stuff the bank would own. And the whole point of this is to make sure that they have enough capital cushion themselves. So how I view this is just like how the bank views the mortgage loan to value. I view this as the bank's loan to value. Now, it's not the loan to value, it's capital. So that would be your common equity and stuff like that. So your share price could actually affect this instead of things like DRIP. But this is how I treat it in my head. It's not accurate, but that's just how I view it, because it helps me make decisions quicker. Here you can see the forecast is for interest rates to drop, and you might be like, well, that means the margin should start going down for bank. And so that's the time thing. So because rates went up so quickly, we saw the deposits reset quicker, and we've still been seeing this loan book slowly re-rate higher. Now, because there's such a big gap between what the loan book is currently at, see that, like say that 3.6% fix that we saw, even if rates come back down to 4.75 or 4.5 or even 4 during 2024, you still have that upside for the bank. At the same time, the deposits that they're paying you on those GICs are going to start coming down. So you're actually going to see margin expansion if rates stay the same or if they start decreasing. Finally, here, I just wanted to show, I thought this guy was pretty good. I think it's wow.com or it's Hanif Bayat anyway on Twitter. He does a good job. And you can see just how much of the banks have over 35-year mortgages. And you might be like, how is that possible in Canada? Most of them issue 20, 25 years. One of the things that happened, well, the banks don't call them this. They actually, here, portfolio mix, you can see RBC just says like 27% of their portfolio is variable, right? And 73% therefore is fixed. But what's actually true is that of this fixed rate mortgage, they might have a fixed payment, but they actually have a variable rate. So what we're seeing is the ones that have a variable rate but a fixed payment are basically the banks are just extending the mortgage on them. So one of the reasons why Scotia's loan growth has been weaker than the others, aside from them tactically doing it because they didn't have cheap financing to lend, is that they issued, or they have quite a bit of fixed rate variable mortgages. So basically you still pay the fixed payment even though the rate's going up on you. And how that works is to just add it to the end. So they've seen their loan growth still not decel too much because they've been able to add a link to the mortgage basically. And that's why you have, just say TD has 19% over 35 years. BMO has 25% of their mortgage book over 35 years. And again, these aren't small, just 22% of RBC over 35 years. 22%, and I think of the 880 billion in lending, 550 was mortgages. So do the math, a decent amount of people in Canada have mortgages that are very long, which makes them very sensitive to interest rates, both on the up and down, probably more than what's implied in what people model. Anyway, the reason why I want to do this today is because they did a call January 9th, I think today, January 11th at the time of filming. But anyway, they're basically saying they think their NIM is going to go up 200 basis points, which again doesn't sound like a lot, but it's and it is only up to 200 basis points on the mortgages that are resetting. So it's not like, oh my god, the whole book's getting that much. It's just a percent of the book is resetting at the higher rate still. And I think that's going to be the trick for this whole 2024 year. Is how quickly does the NIM reset versus how quickly do they have to increase provisions for the increased credit risk. And I'm hoping for an overreaction on the provision side. Here is just kind of what they're saying in terms of kind of like trying to measure the credit risk. And they're like, again, 14% of our over 300 billion mortgage book comes up for renewal in 2024. So they're basically saying they don't have that much credit risk because only so much is resetting this year. So the credit risk should get better as the loans, as the mortgage rates come back down, which is probably partially correct. But this is the comment I just thought was interesting. This is just for viewing purposes, not for. But here you can see that roughly expect $400 payment increase to the average mortgage holder in Canada. So that's $400 payment every month, right? So that's $400 less per the household, or 14% of their mortgage book. That's going to discretional spending still. So the below constrictor, Canada is still constricting, and I just thought that paragraph kind of sent that point home. And the last one on this conference, which was interesting, it's an RBC Capital Conference. That's one of the reasons why I'm picking on RBC. But this one was kind of interesting too. Again, they're kind of talking about credit quality because that's the biggest unknown is how much the PCLs have to come. And RBC is basically saying they expect peak PCL to come through 2024 as we still see consumers struggle with higher rates. So we should see provisions peak, just like they're saying, just like they're guiding. But the trick is, when does the rate of change in the provisions peak? Because so far it's been very gradual in 2023, except for maybe Q4 for Bank of Nova Scotia. So what I'm hoping, and this has happened in the past, is when the provisions, like all of a sudden, whether they guide it up or they just accelerate it on that quarter, usually that's like the best time to buy these banks. So that's kind of what I'm hoping, because at the same time they are having the NIM reset, and I no longer have to juggle the two when one starts getting priced in. And so that's what my game plan is. So take with that what you will. I'm hoping to do some more banks. They're all kind of have their unique little quirks, but I think if you can get the NIM and the provision cycle, you're probably going to do okay in Canada. But yeah, I'd like to know your thoughts on Canadian banks. They've generally done well over time, and have a great rest of your weekend.